The Exponential Moving Average, or EMA, is one of the most widely used indicators in technical analysis. It reacts faster to price changes, adapts to market shifts, and helps traders stay aligned with momentum. But to use it effectively, you need more than just the indicator. You need to understand how it truly works behind the scenes. In this video, part of our series, The Best Trading Indicators Explained Step by Step, we'll break it all down. No hype, no guesswork, just logic, structure, and real-world examples. Let's get started. Let's start by adding an exponential moving average to the chart. On TradingView, click on Indicators, then type Moving Average Exponential in the search bar. You'll see several results, including community scripts and custom indicators. Make sure to select the one listed under the Technicals category. That's the official built-in version from TradingView. By default, it applies a 9-period EMA to the closing price. Once the line is visible on the chart, hover over the indicator name at the top left corner and click the gear icon. This opens the settings panel where you can fully customize how the indicator behaves and how it looks. Now let's go over the full settings of the Exponential Moving Average, starting with the Inputs tab. At the top, we have Length. This controls how many candles are used to calculate the EMA. The default is 9, but for this example, we'll set it to 10. Next is Source, which tells the indicator which part of the candle to use. The default is Close, meaning the closing price of each candle is used in the calculation. But you can change it to Open, High, Low, or combined values like HL2 or HLC3. Then we have Offset, which shifts the entire line forward or backward on the chart. This doesn't affect the calculation. It's only a visual adjustment. A positive number moves the line to the right, a negative one shifts it to the left. Below that, you'll see the smoothing section. By default, the type is set to none, which means no extra smoothing is applied. But if you want to smooth the EMA itself, you can select another moving average type, like SMA or WMA. Once you do, the length field becomes active and lets you set how many periods the smoothing should use. The BB standard deviation field is used in Bollinger Band calculations and isn't relevant here. Under Calculation, the time frame setting controls which chart interval the EMA will follow. Set to Chart, it matches the current chart time frame, like 5 minutes, 1 hour, or daily. The checkbox below, Wait for time frame closes, ensures that the EMA is only updated after each candle fully closes, giving you a more stable and reliable reading. If you uncheck it, the EMA updates live as the candle is still forming. Lastly, under Input Values, the option Inputs in Status line controls whether the EMA's value and settings appear at the top left corner of your chart. It's useful to keep this enabled for quick reference. Now let's switch to the Style tab. Here, you can customize how the moving average line looks on the chart. The EMA checkbox at the top lets you show or hide the line. If you turn it off, the indicator still runs in the background, but nothing is drawn. Next, you can change the color, line style, and thickness. This helps you make the EMA more visible, especially when working with multiple indicators. On the output values, the precision setting determines how many decimal places are shown. You can leave it on default, which automatically adjusts based on the instrument you're viewing. Then, you have two display options. First, labels on price scale show the current EMA value as a small tag on the right side of the chart, aligned with the line. Next, values in status line display the current value and input parameters in the top left corner of the screen. Finally, we have the Visibility tab. This tab controls which time frames the EMA will appear on. You'll see options for ticks, seconds, minutes, hours, days, weeks, and months. Each row lets you set the visibility range, for example, from 1 to 59 minutes or from 1 to 24 hours. If a box is checked, the EMA will be visible when that time frame is active. If it's unchecked, the indicator will be hidden in that range. At the bottom, there's also a Ranges option, which allows for more advanced visibility control. But in most cases, you won't need to use it. With all these settings adjusted, your EMA is now fully configured and customized. In the next step, we'll look at how the exponential calculation actually works and why this indicator reacts faster to price changes. Now that we've covered the default settings of the exponential moving average, let's take things one step further. To help you truly understand how the EMA works, we've developed a custom indicator that breaks down the full calculation, right on the chart. It's designed to mirror the behavior of the standard 10-period EMA, but with one key difference. It shows exactly how each value is weighted and how the average evolves step by step. On the right side of the screen, we have a breakdown of the last 10 price values used in the calculation. These are labeled from P0, which refers to the most recent candle, the one currently forming, all the way back to P9, which represents the candle from 9 bars ago. Because P0 is still in progress, its value constantly updates until the candle closes. That's why the tip of the EMA line may move slightly in real time. The most recent price is still changing, and that directly affects the calculation. This brings us to the core of the exponential moving average. In step 1, we calculate the smoothing factor, also known as alpha, using the formula. Alpha equals 2 divided by length plus 1. For a 10-period EMA, alpha equals 0.181818. In step 2, we define the previous value of the EMA, labeled as EMA previous. This is either the EMA from the last candle or a seed value, such as a simple moving average. In step 3, we calculate the difference between the current price and the previous EMA. Delta equals P0-EMA previous. In step 4, we apply the exponential formula. EMA equals EMA previous plus alpha times delta. What you're seeing on the chart is a dynamic, real-time representation of how the average is adjusting, with more weight given to recent prices. Unlike the SMA, the EMA responds faster to new data, which makes it especially useful in fast-moving markets. And that brings us to something we'll repeat in every video of this series, because truly understanding this one principle can change the way you trade. If you've already heard this message and it resonates with you, feel free to skip ahead. But we strongly encourage you to stick around and even replay it until you can repeat it by heart. This isn't just theory, it's the foundation of consistent, sustainable trading. Here's something every trader needs to hear, especially if you're just starting out. Indicators are not magical signals. They don't predict the future. They simply reflect what's already happened. They're tools, valuable ones, but still just tools. They help you read context, not control outcomes. The real problem begins when traders expect certainty. When they treat indicators as if they guarantee success, that mindset leads to frustration, disappointment, and an endless cycle of jumping from one strategy to another. To really understand why this happens and how to avoid it, let me share a powerful idea from Mark Douglas, one of the most respected voices in trading psychology. He once explained that many traders believe their system or indicator told them what was about to happen. But in reality, the market moves because of the conviction, or lack of it, between buyers and sellers, not because of any mathematical formula. He pointed out that most of the reasons we hear in financial news are just stories made up to sound logical after the fact. And this illusion of certainty is what makes traders feel betrayed by their systems, thinking the methodology failed them, when in fact, no technical method can predict what will happen next on a trade-by-trade basis. As Mark said, technical systems only tell you what's likely to happen over a series of trades, never the next single one. And just to show how unpredictable the market really is, Mark once told a story about a trader he mentored. This trader was an excellent analyst, one of the best Mark had ever met, but he struggled to execute trades successfully. So Mark advised him to focus on analysis instead of trading other people's money. The man followed his advice and became an analyst for a major firm at the Chicago Board of Trade. One day, the firm's chairman, an old-school grain trader, sat down with him. The chairman was skeptical about technical analysis and wanted to see how it worked. As they watched the soybean market move within a range, the analyst confidently said that the current price would be the low of the day. The chairman laughed, picked up the phone, and ordered the sale of 10 million beans, 2,000 contracts, instantly driving the price down 10 cents. Then he turned to the analyst and said, "If I can do that, anyone can." And that's the lesson. Sometimes it takes just one player with enough size or conviction to completely destroy your perfect setup. So, The next time you find yourself waiting for that perfect signal, remember this: it only takes one player with enough power to make your setup irrelevant. That's why mindset matters. That's why context matters. And that's why indicators, no matter how popular, are tools, not crystal balls. And that wraps up our breakdown of this indicator. In every episode of this series, we'll keep reinforcing the same core message. Indicators don't give you an edge. How you use them does. To help you move from theory to practice, check the card above and the description below. We've linked real strategies that use this indicator in action. And if you want to keep growing, take a look at our full training programs. We've got smart money concepts to help you understand how the big players move the market. Technical analysis for day traders, focused on fast, practical decision-making. The Wyckoff method, to help you read price and volume with structure. And most importantly, our complete trading psychology playlist, because no matter what strategy you use, mindset is what makes it work. Take the time to study. Focus on building real skill, not chasing shortcuts. Because at the end of the day, it's not the indicator that makes you profitable. It's how well you understand and use it. I hope you enjoyed today's video. If you found the content helpful or engaging, please give it a like, as this helps the video reach more traders like you. And don't forget to subscribe to the channel and turn on notifications so you never miss our latest insights on the markets and practical trading strategies. Sharing this video with your friends or on your social networks can make a big difference and helps our community become stronger. Now, if you want to go even deeper and get access to exclusive content, early video releases, and extra tools to support your journey, consider becoming a member of the ComLucro trader community right here on YouTube. It's a way to support our work and a smart investment in your own development. Thanks for watching, and I'll see you in the next video.